Welcome to Decision Points. We're about serving business owners. Today's guest, Brandt Bowden. You're in for a treat. Let's go. Welcome to Decision Points. I'm Doug Hudson.
I'm Scott Wood.
Welcome, Brandt Bowden, CEO of the Hanover Company.
Thank you guys for having me.
What's
Appreciate
up?
it.
How's
Glad
the
you're
day?
here.
Thanks so much.
Yeah. You live in Houston?
I live in Houston,
Yeah.
in the Galleria area. The
Yeah.
company's out of Houston. We build apartments nationally across the U.S. About 18 markets, both multifamily and industrial. Been hacking away at it for about 42 years now.
Wow.
I've not been there for
You've
42.
not been hacking at it for
I've
40.
not been hacking it, but the company's been hacking away for quite some time.
I'm sure we will deep dive into that, but who started the business?
Business was founded by my dad and another gentleman. They founded it in 1982, and it was a very small, humble company for a very long period of time. And it was kind of very classic, life of entrepreneurs where they, every deal was a big undertaking to get done. And, they spent, I was born in 1978. I graduated college in 2000. And if you had looked at every deal the company had done through college, it was about just over $1 billion. And by the time we kind of got to 2016, we were doing $1 billion a year. So just kind of a very humble beginning, and we were able to kind of grow the machine pretty well.
And what was your degree in college?
I was an English major, which is the world's most useless degree.
Sets you up really well for real estate,
Yeah,
didn't it?
exactly. Yeah. Great for in finance.
Now, my oldest daughter has an English degree, so be careful here.
Yeah,
Well, be careful. I'd say he did pretty well.
Well,
It's a
no,
pretty
he
good
said,
model
yeah,
for
yeah.
Well, I mean, you'll
But he
appreciate
did say
it.
useless.
It's
He did say useless.
and I basically specialize in Shakespeare, so it's. I mean, I
So even more useless.
I took a pretty useless degree and said, okay, let's go roll the clock back 400 years and say let's spend our time on that. But it was I was basically not quite as serious the day that we were deciding majors. I basically flipped a coin to make the decision. I had an equal number of psychology classes, an equal number of English classes, and I was like, I like them both, and I flipped a coin.
And where'd you flip this coin at?
I was at Dartmouth College, so it was good liberal arts degree. You're not going to do anything that's all overly business specialized anyway.
Yeah.
But you learn how to learn, and you learn how to get pushed, and you're in a crowd of very smart folks that are pragmatically intelligent, and it's a really fun place to have college.
So you flipped a coin. It comes up English. But then did you specify that you were going to be intense on Shakespeare?
I just Forrest Gump my way into that one.
We all love Forrest Gump, but what do you mean by that? What do you mean?
I just like kind of randomly a class here, a class there, and you kind of look back and like, oh, I took 4 Shakespeare classes. Like, okay, I guess.
So what was the attraction like for the first class, and then the second, and then the third?
Yeah, it was like the original class was Shakespeare 1, and I found it interesting, so I ended up doing Shakespeare 2, and then there was some senior seminar on Hamlet. So I literally spent an entire 10 weeks on Hamlet, which was useful one time because my dad and I were in New York, and Jude Law was playing Hamlet in a production, and I was like, all right, Dad, we're going to go see this, and this is what Hamlet's all about. So I had like one moment where it was actually very useful.
No, you laugh. We laugh. I want to ask again, and maybe the answer is no. Are there moments that you reflect, or how did that did it benefit you in any way to what you're doing today?
I mean, you write so much
Yes.
as an English major. And so I went into finance and I'd had real estate internships along the way.
Okay.
So I could certainly speak finance. I understood what return on costs were. I understood Excel. But, like when you articulate an idea in anything you're doing, like how you draft it up, how you write it, how you convey ideas, like it's a really critical piece of just business in general. And I feel it's probably a piece that most people undervalue. But it's really important.
Yeah. Yeah. So just the writing, communication skills, I'm sure have served you very, very well.
So when you were in college taking Shakespeare, did you have a sense for what you wanted to do? I mean, had you already
I was going into real estate. I mean, I came from a real estate family, and I kind of recognized early that I enjoyed it. It was interesting. I didn't know exactly how I was going to navigate through. I because I was in a place that had a lot of investment banking folks, it seemed like investment banking and finance was the bird's eye view where you got a really good training ground for your first apprenticeship leaving college. And like investment banking is great because you basically, in the period of 2 years, you basically work 4 jobs. And they basically just work you to death.
Right.
And you get really skilled at some basic skill sets. And, and you can, whatever the next move that you make, it can be very useful just because you were very competent in some just underwriting and Excel and just building books and all of those things. And then you can kind of parlay that into kind of more higher IQ function.
Did you do that in New York?
I actually did in San Francisco.
You did?
I was
Okay.
B of A Securities in San Francisco, and I was with the real estate banking group. And and it's like one part you enjoy it because you're learning a lot. On one part you don't like it because I always sort of felt like you were the engine in a car spinning in the mud, and you're going 100 RPMs, and the car is just barely moving. But you're the fuel that kind of moves it. And it's like and you're on the service side of the business as opposed to the principal side. So when Project Weekend walks in the door, you tend to Project Weekend. So so I like that piece of it. I didn't totally love, but I learned a lot. Ended up at Hanover because they were going to expand into the Northeast, and they kind of came and said, "Hey, we're going to go hire somebody to go do this." And initially, I was like, "I got some more time at the bank," and then I kind of ultimately was like, "Well, that's stupid. I should call these. I should take a look at this."
Yep.
But before I jumped into the family business, I always wanted to feel like I didn't need the family business to be useful and productive in life in general. And after kind of a while of being out, working 120 hours a week, you're like, no, I can hang with anybody. I can be productive. I can be useful.
Yeah.
And I kind of joined Hanover at an unbelievable time. It was 2002.
Okay.
So we still had a very good real estate run in front of us before GFC, the Great Recession. And I was covering a market that Hanover had never developed in. So, there was no rule book.
Yep.
And
that market was?
I was basically in Boston, Philadelphia, and DC.
Okay.
And so I was basically, for the first 90 days, I was like in a car running around New York, New Jersey, Connecticut, Boston, DC, Virginia, and ultimately got a deal under control in the first 90 days in Massachusetts. And it was kind of one of those just, fluky kind of things, and got a little bit lucky, got a land seller who took pity on a kid at 24, and he had a bunch of like legitimate, well-versed developers in that market. And he just said, well, kid, you happen to show up on the right Friday. I've got these 4 offers. Here's the numbers. And I said, I'll offer $200,000 more than that one, your best one. And he said, sure, deal's yours. I told the guy that I was reporting to, he's like, he did what? What a moron. I was like, hey, come on.
All right. There's so many lines here. Let us back up a little bit. Talk to us about the early formative years. So you're growing up in Houston. The family is in the business. Brothers, sisters. What are those early years like for you?
So, family of 2 boys.
Okay.
My father was like a natural born entrepreneur and basically never worked for anybody in his life.
Yep.
At some point in time, like in the early 80s or late 80s, jobs are, real estate, tough market. And I remember he was kind of complaining to his wife, and my mom was like, well, honey, why don't you just go get a job with somebody? He was like, oh, honey, it's not that bad.
I would never do that.
I can figure this out.
Like, come on, let's not. My dad's always been an entrepreneur, always been in real estate. And it was, the company was small enough that my first job there was, I was 9 years old.
Yeah.
In fact, actually, we had a 40th celebration, and somebody dug up the job description for the 9-year-old errand boy. And like one of the things that I was not allowed to do was answer phones. So I did not have a lot of responsibility early in my career.
The errand boy, I don't think could drive a car at 9 years old.
I could basically drive coffee to like an office, and that's about it. So I have a younger brother who's like, a 6 foot, great athlete, football player guy. And so we both grew up in the business and really gravitated towards it. I did a little bit of work outside and then came in. My brother basically took a small ski season off and then joined the business out of college. And, like the young formative years, you're seeing an entrepreneur struggle with how to grow a business. A stiff breeze at various points in time probably could have knocked the business over. And it's kind of, those formative years as an entrepreneur in your like 20s and 30s are kind of the years that really define how you think of your business. And as the business grows, the business becomes more formidable. So even as you've kind of had transitions from like what we were then to what we are now, it's like, okay, we can take different risk profile on various deals and the company itself, and still want to run a very de-risked organization. And part of the goal is as companies mature and get more mature and could take on more risk, you would say, but I ultimately want to drive this risk profile down over time. And I think, that mindset has been probably one of my father's mindsets as he thinks about the business. And my brother and I are kind of saying, well, the organization's a big organization. We can use it as a battering ram to smash down some doors that we otherwise might not have been able to smash in those early years. So let's kind of think about it both ways if we can.
Is your dad still involved in the business?
He is. He's an executive chairman. We meet, we kind of laugh. It's a 3-person board, my brother, my dad, and I, and we talk about, the transition we had was he got out of the dailies of the business to try and get into a more strategic role. So the roles and responsibilities were, if something needs to be done in 24 hours, it's, my responsibility and my brother's responsibility. Mm-hmm. And if you look at the roles and responsibility my brother have, I'm a CEO, he's a COO, but we're equal partners in the business.
Yeah.
And I would say that, I think my brother is incredibly intelligent. He is a phenomenal partner in life and in the company. And I basically run the company from an idea to, through the development division, the construction division, all report to me. But once a project has hit a C of O and we're ready for it to start leasing, it rolls over to my brother's division, and he's got property management, asset management, some of the internal operations. And from time to time, we stick special projects in his court, which can be, it can be a variety of things.
Yes.
Yeah.
And so, he takes the back half of the business. But it's, if you think about it, it's like my dad was a founder, had a partner, but my dad was really the driving force of the business in its early years. But there's one of him.
Yeah.
And he's kind of got two very young and energetic, reasonably qualified, sons who there's two of us. And so we can kind of cover more ground together.
Yeah. How old's your dad?
He's 75 now.
Okay.
And he's a young 75.
Does he come in every day, or
he comes
does he have an office?
Office is right next to my brother and I. He comes in regularly, but again, he's also operating on some other kind of nonprofit endeavors. And he's done a really good job of trying to limit his scope so that Jeb and I really do have the authority to run the areas of the organization that are kind of within our purview. Mm-hmm. And he's respected those lines of authority, and I got to give him tremendous credit for it, because it's like it makes for a high functioning organization. Yeah. And it's not just, family businesses are complex, right? Family dynamics are complex.
Right.
And and you have the baggage of the family.
Yep.
And to run the business alongside that, I mean, there's just a lot of knowledge and almost like biases that you have with your family. Like, this guy is always this, but like everybody sort of evolves over time. Mm-hmm. And who we are in our professional lives and who we are in our personal lives can be different things. And we all occupy, because my brother and I occupy different spaces within the business, we kind of have different levels of expertise in various things in the business.
Yeah.
So, I think he's done a really good job of respecting all of that.
How did that transition go? Was it pretty direct and pretty, let's get in a room and think it through? Was it methodical? Was it fairly overnight? As I love this, Brandt, so many of our listeners are family-owned businesses, multi-generation. You guys are in a second generation now.
Yeah.
That's such an important step. Walk us through your all's.
Yeah.
And hopefully you didn't do everything perfect. If there's a few drop balls in there, I hope you'll be willing to share some.
I mean, there's plenty. I mean, it's an interesting process. So the transition process was really initiated by my dad, Murray. He got to a point where he kind of mentally, or so almost intellectually knew a transition should happen.
About how long ago was this?
So I became the CEO in 2018.
Okay.
And he was grappling with, how do we do it? What's the right step? Even like, Is it Jeb and Brandt co-CEO? And he just had a lot of iterations on what this could be.
And is he talking to both you and Jeb about this?
Yeah, and he's thinking about it, and he's talking with other folks. And what was actually the most critical and kind of unlatching the playbook was I signed us up for this families and business course at Harvard. And that was kind of in the fall of 17.
Okay.
And we were grappling with how we do them. We're having conversations about it. And we're talking around it a bunch. And I sort of like, when I went to Harvard, I was like, okay, it felt like the three of us who had never gone through this transition, and we listened to other people going through the transition, but it's for you and your organization, it's like you're kind of in a dark cave.
Yeah.
And we went to Harvard, and it's like, they're going through, okay, here's the plethora of ways that you can do this with the range of outcomes. And what Harvard does is they in that program is they took a week, they pair you up with a consultant, they have classes in the morning, and then you meet with the consultant in the afternoon, and you outline, this is our business, this is what we're trying to get through and do. They also kind of got to where they reframed the business and the family less like a family business and more like a family system. Because then as these families go from G1 to G2, you oftentimes have family members that are owners of the business, not participants in the daily activities of the business.
Right.
And you get into G3 and like the families get wider and wider. And so Harvard just is like, look, it's a system. Whether it's the business is just a piece of the system. And there were international families there who were on G4 who had like 15 people there, and they had a business leader. They had a family leader. They had family rules. They had business rules. And there was just a lot more structure around what a family could be that happens to be in business together with members who are in the family who are not in business together. And it really did broaden our mind about what a family system can be. But it really did get my father solidified in his thinking about, okay, one, this is a great idea. We need to do this.
Yep.
And it helped him define, here's my lane. And it helped him define, here's what Brandt's lane is, here's what Jeb's lane. And we were basically, when we kind of made okay, here's roles and responsibilities, it was consistent with what we've been doing for 15 years prior to this. So there was nothing outlandish there. But I do think it kind of gave everybody the courage to sit there and say, this is the playbook. And when we were there, I was like, we kind of go into Harvard in a dark cave, and you kind of realize, hey, there's a light switch right over there.
Yep.
Just flip the light switch, and all of a sudden, here's 3 different options on how you can effectuate this transition. And it's been smooth. It's not been without bumps. I think anytime you have like you have interpersonal issues that come in and creep in and can be like, they can hurt. I mean, they can be hard. But, I would say that we have a very high functioning, family relationship. We have a high functioning business relationship. And I think the business relationship benefits from the family relationship. But like there's some real keys to how that works, and my dad has said this for years, and I think it's very true, which is like at some point, my brother and I always have to say, look, 1 + 1 equals something more than 2. And so there's got to be some complementary relationship that we are going to be better together. And I would sort of say, like, Bowden's, we're pack hunters. Like, we do real estate together, we do charity, and like we support each other in charity. So we're really sitting there saying we are much stronger moving together when and where we can.
What was a hurdle, stumbling block? What was one of the most difficult issues to get through?
For my dad, probably it was like the transition from knowing intellectually that this is a good idea to getting there emotionally was probably hard for him. And he got intellectually there before he got there emotionally. It took kind of years to get there emotionally. At least I suspect. He may kind of view it differently. But I mean, in essence, like the business for him was a bit of like his third child.
Yeah.
And, he had as much vested into it. He loved it as much as probably you love Jeb and I. And you kind of like, you have to kind of give it up a little bit. You kind of have to, there's a process there.
Like you got to let a child grow up and fly away. Same thing he had to kind of do with his business.
Right. And then the other challenges are, I do think to make it all work amongst, Murray, Jeb and I, like, we all have to subordinate the ego at some point in time to whatever it is that we're working on. And not all of us do it perfectly all the time. But you always have to kind of sit there and take a step back and realize like no decision that we're making is ever going to make the business. Some really bad interpersonal actions will sink it. And so you always kind of have to sit there and say like, look, I'm always going to defer to a certain extent because like, again, nothing that we're talking about, whether if I have an opinion on something, it's like, it's an opinion. We're projecting into the future. Like nobody's ever 100% right. And different people have different vantage points. And in the stuff that we talk about on a daily basis, like it's never so important that the business is going to, make or break over it. So I think like you have to sit there and always take that step back and sit there and say like, we got to support the family first. And if we can keep the family working well together, the business will work fine. Everybody's smart, everybody's motivated, everybody is high functioning, and we got to keep the high functioning, and that's the real challenge / the focus needs to kind of always remain on that.
That's really insightful.
Yeah.
I don't know if we want to. I'm going to say back to you what I think I heard you say, because to listeners who own family businesses, I think you just unlocked a really, really critical door. What I heard you say is you guys have decided there's not really a strategic decision that can sink your business.
Correct.
There are family dysfunctions, interpersonal cooperation, subordination. Playing nicely together as a family is what would kill your business.
I believe that. I believe that.
That's huge. I don't know how many people hearing that the first time would agree with that.
Yeah.
I mean,
Why do you all believe that?
we're in a business that I think is growing, right? The population in the United States is going up. So I don't think we're in a business that's a sinking business anyway. So I stipulate it with that. And then, as long as we're not doing something, taking on more leverage than the business can sustain, or on an asset. There's some guardrails that we all have agreed saying we're going to operate this business like within this kind of range. And we think if we stay within this range that we will survive. Like when Jeb and I first started taking leadership positions, and when he first kind of put me in the CEO chair, I was like, look, we're in the car. Our only job is don't wreck this car. As long as we don't wreck this car is going to take us, hundreds and hundreds of miles to places we can't even imagine. And we're going to keep driving this thing for the rest of my life, for another 20, 30, 40 years. And so just don't wreck the car. And I really do believe that, because again, it's a healthy business. It's a healthy industry.
Right.
We're not building buggy whips.
Right.
So, and I think as long as we can keep running our business well, and running your business well is not strategic decisions. Running your business is like getting up every day, working hard, working the business as hard as you can. And there's a trust and confidence I have in my brother. I think he has the same trust and confidence in me that if we are working hard every day, good things are going to happen just fine.
Yep.
And fortunately, he works really hard and I work really hard. Mm-hmm. So we're not in some of those situations where it's like, and I have friends who are
One's
in family
absentee,
business.
right.
And that was probably the original dysfunction with my dad and his original partners. Like one was really driving the business and one was kind of like, okay, I think the business is as good as I need it to be. And I think my dad was saying, no, we're going to keep growing this sucker.
Mm-hmm.
Yep.
Tell me, give me a sense for the business. So how many employees, how many offices, how many projects on the ground right now?
Yeah, so the company itself is about 660 employees right now. About 100 of those are India. The rest of them are domestic. Okay. The business is a building of apartments, and we just started an industrial division. Okay. So within that, the lines of business are basically a development company, a construction company, a management company. We are trying to, on a normalized year, do north of $1 billion of production starts a year. The last couple of years, it's been off. Capital flow has been terrible, and big capital priced items are a little bit off. Mm-hmm. We think we start seeing recovering in capital markets, and I think we've got a pipeline that we can start pushing that back up to a normalized rate. And if you kind of think about the capitalization of that $1 billion, about 60% of it's debt, 40% of it's equity. The debt guys are all big bulge bracket bank players, and the equity is a whole cadre of kind of Pers and Stirs advisors, large insurance companies, a little bit of family office here and there, but our average deal size is about $150 million right now. So the average equity check is a $60-ish million check.
Yeah.
So it's really kind of a big institutional kind of capital source. And the company's been more steady than not over kind of the last, let's say since 2018.
Yeah.
And we've kind of had a very steady sort of generally upwardly trending, production pipeline. 23 was the first year down since I've been in the chair that I'm in right now.
And then all that's multifamily up until now, where you've kind of now ventured into the industrial.
We just did our first industrial start in July of this year.
Okay.
Where's that?
It's in Austin, Texas.
Okay. How was that decision to get there?
So you kind of sit down and we have our board meetings and we said, okay, here are a few strategic initiatives. My brother and I have a tendency to agree like 96% of the business stuff. My dad and I would sit there and say probably agree like 92%. So we have really deep agreement, generally speaking. And Jeb and I, the pandemic had some interesting moments, right? All of a sudden we said, hey, we just had some of our business nationalized where I can't control the real estate. I can't evict people in certain markets. And all of a sudden, payments went way down. You're like, what would ever happen if the U.S. government actually nationalized housing? Because it happens in some places in the world. So it'd be nice to maybe have another business that maybe is not quite vulnerable to that situation. And, if you look at what we're really good at, we are great at finding land sites. We're great at, the math behind good deal, bad deal, good idea, bad idea. We're great at navigating local entitlements. We're great at compartmentalizing land risk. We're great at construction, and we're great at capital markets. So, and we've got a great management company on the multifamily side. We're going to build it on the industrial side, but we're not quite there yet. But most of that skill set was very applicable to an industrial business line that is functionally a very similar set of skills. It's just a different product type. So we were like, okay, we start this now. In 10 years, we'll be really good. We had a lot of capital partners who approached us and said, y'all are so easy to work with. Mm-hmm. I would love it if you got into this business. Mm-hmm. And, one guy tells it to you and you're kind of like, okay, you kind of blow it off. The third guy was like, no, I'll give you $200 million. I'll put you in business. And at that point I was like, okay, we got to take this seriously. Yeah. We ultimately said, we don't want to do that. We want to run our own business and control the business. And we kind of figured, okay, we can start with, about $20 million. And we had key hires that we thought we needed to build out. And then we could leverage the existing infrastructure that we have in the organization. So we thought we actually kind of get going on a relatively, I don't want to say, on a relatively sort of simplified platform. Mm-hmm. And then the Fed starts raising interest rates. The whole capital markets seize up. So it was a great idea. Horrific time. At some point, we kind of made the key hires in early 2022. We kind of had a portfolio of assets tied up in Texas and realized the whole framework for returns moved on us. Mm-hmm. So we dropped that whole portfolio and said, okay, we got to hit the refresh button and start over. But, so we started over and, put a site under contract in Austin, Texas, has a bunch of other stuff in the East Coast under contract now. And so we kind of have about $800 million of opportunity that starts getting put into production, July of this year, kind of through kind of early 26 of Q1, Q2 of 26 in a couple of years.
You were talking about agreement. Was there some disagreement? Did you get to 89% on the going to industrial or something?
No, really the pitch was Jeb and I kind of came together. We basically built out an income statement. We said, look, this is the skill set that we've got that we think of my dad has always said, look, we're an inch wide, mile deep. And we're like, think about the inch differently. Think about it's not about apartments. Apartments are the byproduct of these 5 skills. Mm-hmm. But these 5 things translate to this other thing over here that we could take advantage of. And it could kind of think about like 2 ships sailing in the sea. And so we can literally build another ship and sail it. And in the event, something like some black swan catastrophic event hit multifamily where just bad policy steps in and you all of a sudden you're like, my business doesn't work for a few years. Like we would still have this. Mm-hmm. So that was the thesis behind it. And, because of the slowdown in interest rates, it's cost more money than we initially thought. Mm-hmm. But the first deals that got going, our capital partners are JP Morgan, Carlisle, Northwestern Mutual. So all of our big blue chip guys that are supporting us in the multifamily business jumped right over to industrial, and they're supporting us over there. So it was weird. All those term sheets kind of came in the shop like within 60 days. My dad was a little skeptical. This was kind of like early this year maybe, when all of a sudden it was like, okay, here, term sheet 1, term sheet 2, term sheet 3 is like, I think this is going to work. And like the pref promote business is a great business. And intellectually, I think he was there. He was just like, are we really going to be able to teach this old dog a new trick? And I think he was like, I don't know. I'm really glad it worked out.
Yeah.
We still have a ways to go. Like we still have to really get this thing up and rolling, but it's like the small data points that you need to sit there and say, we think this business could be successful. I think we're on a path.
Yeah.
Do you have kids?
I have 4 kids.
What are the...
I have 14, 12, 10, and 7.
Awesome.
So and my brother's got 3 kids, and they're basically just sent one off to college, and he's got, I'm embarrassed. Like his middle one's going to be like 11. His youngest one is 8.
I'll go here. We're all 3 dads in. I got to believe your dad in that moment, Brandt, or in these moments now, again, as a parent and a business leader, he's a little bit skeptical because he did what he knew for so long. Why stray from that? And I think you made the comment or said, I can promise you your dad is ridiculously proud because he said, I always wondered, or maybe I never even considered it, but he's entrusted, he's grown, he's prepared, he's nurtured, he's allowed this process. And now you and Jeb have really rethought the business. Here's what we're good at. That is transferable. And to your point, I understand it's not completely proven yet, but you had 3 massive blue chip companies say, we believe in you. Here's the money. I can promise your dad's ridiculously proud and going, they're actually smarter than I am. They're making this happen.
I wouldn't concede smarter than he is, but we're doing good enough work for now.
That's a humble perspective.
What's interesting about this, and this happens with every industry. I mean, you just look around, and for a company or an industry will go for a long period of time with very little change.
Yep.
Yeah.
And then all of a sudden, there's like this disruptor comes in, and change happens. I'm thinking about y'all's little family business, and just. They have a smoothie bowl business. They just opened a store here at Knox Henderson, and we went there for lunch today, and his daughter's running it. And, you think about that business and how stuck it is in terms of the model. But then, what you guys have created is something different. And same thing in your business. You're creating a different dynamic on the same platform that's been there for years and years and years, but you're thinking about it differently. And part of that is you almost need this younger generation to come up and kind of operate with, I won't say no fear, but maybe less fear. And you had the platform in place to be able to take some risks that maybe your dad couldn't have taken back in the day, right?
Well, it's certainly a different business now, right? I mean, like when you just have a bigger machine, like a miss isn't the stiff breeze is going to blow you over, right? So you can make an effort to do something a little bit different.
That's right. Whereas, your dad 40 years ago, like all they could do was go a mile deep.
Right. And one miss takes you down.
Yeah. Correct. One miss, you file bankruptcy and you go start over. But Payne is also a great instructor and innovator. And your all's thinking of the potential nationalization really got you willing to say, okay, how do we talk to us about innovation at Hanover?
It's an interesting question because the apartment business in general moves slowly. You have an idea, you entitle work for 12 months, you go build it for 2, and then you start. So after 3 years of sort of thinking about it, you realize if it was a good idea or a bad idea. So it's not this like short life cycle of product. That's kind of like every year something new is happening. And I would sit there and say, like, in general, the 750 square foot unit or the 1,200 square foot, it's like it evolves slowly. It's the same space. and we have common area spaces that are evolving slowly. But there's a ton of stuff that happens like between the walls of buildings, sound attenuation, new products come to market. If I were to show you a building that was 15 years old and say this was like what was nice then, you'd be like, okay, taste and style is totally different now. But and so the materials that go into these things, it's very different. HVAC systems, like there's a whole, again, you can't see it, but it's like the power that our buildings use today might be kind of more like 40 to 35 cents per square foot, whereas pre-2008, it was $1 to $1.20 per square foot. So it's like there's stuff that's going on that, it's a lot of little things, and it's like you're not moving the needle fast, but it does move.
Yep.
And and it costs more money to kind of do this, but cities are changing their building codes that start making buildings more airtight, and so it's a whole combination of some of the changes forced upon you, some of it you're just getting smarter, some of it you're leaning into what you think your customer might like, but it's and the changes are it's pretty broad, and I think like there's another piece which is going to be the level of service that's going into service your customers is just going to be, the people side is going to be a lot better over the next, call it, say, forward 10 years. The notion, mixed use retail is kind of come in, but as you really integrate food and beverage, because retail is not just retail. Retail has evolved from, malls were a thing, and now of the 2,000 malls, you've got like 500 of them that are productive and 1,500 that need to die. Mm-hmm. And the retail that does survive, it's all experiential. It's all places to be and gather and interact. And to the extent that housing can stitch that into their urban fabric and make something great out of it, that's where some of that urban stuff is going. And then as you get into the suburbs, we're actually kind of like rewinding the clock, trying to drive costs down. And there's a whole movement right now that was ignored for 15 years about trying to get really inexpensive housing out there and produced, and that's been a skill set that's been ignored since like 95. Mm-hmm. So it's interesting because it's like the industry's kind of moved in a bunch of different directions simultaneously. A lot of it's driven by capital, right? I mean, capital has it's the golden rule: the guy with the gold makes the rules.
Yep.
And if capital's sitting there saying this is the inefficiencies I see in the market, like you're not building enough of this is getting mispriced, and so this is where yields are. That's what the industry will produce. So there's a lot of that going on out there, and capital's a little more flexible to do a wider range of things than what they did, say coming out of GFC. Like coming out of GFC, there were 6 cities in America that were investable, and within those cities, you kind of have like your first ring, your second ring. It was only in the first ring was like 75% of the production in all these cities. It was an incredibly small bullseye.
Wow.
And if you look at like the maps of 1987, and you look at the maps of like 2023. And like what dots are on the map for housing production, like they look a lot more similar now into 87 than they did from, call it, 15 years ago.
I want to go this direction. Scott, trump me if you prefer. What's the day-to-day look like for you? What metrics are you looking at? What management style are you and your brother using? What are you using? I mean, 600-700 team members.
Yeah.
100 overseas. What's your day-to-day looking like? Well, so how are you managing it?
So I only have like 5 direct reports. So it's not so like that construction division. Well, we've got a phenomenal guy running that division. Okay. And even though technically we own a construction company, you put a hammer in my hand, I'm going to break more stuff than I'm going to fix. So I have no skill in town. I know just enough to say, we think we've got a problem here. I can't solve the problem. Yep. So fortunately, we've got a lot of guys who are incredibly talented, and I walk into our construction jobs just in awe of what these guys can produce by looking at sheets of paper, and out of basically a couple inches of paper are producing these phenomenal assets, these phenomenal communities. And so I because I'm not very useful there, I spend some time with the people side of that business, but not as much as I should. I kind of grew up basically doing finance. I spent a lot of time with our capital group, it's kind of our chief investment officer arm of the company. And then we have our developers, and we're working with the developers to try and make that marriage of where does capital want to flow? What are they looking at? How do we try and bridge what they think works and what capital thinks work and what I think kind of works? And so like what is going to work with whatever risk profile we're trying to take on in any market at any given time. So I really spend most of my time with the development division and the capital division.
Are those some of the 5 that report to you?
Yeah. Yeah.
Okay. Y'all have a weekly meeting, daily check-in, you get
I've got
emails.
every 2 weeks, I meet with the development divisions, both the industrial and the multifamily. I meet with capital in the same sort of cycle. I will meet, the construction division meets once a month. I actually tend not to attend. I basically just say, go to the head of construction afterwards and like, do we have any problems? We're good.
So your direct reports, you have one meeting every 2 weeks. And on the construction, it's once a month if you choose to go.
Yeah. And because we're, in essence, if you think about our business, we're building, 10, 12 widgets a year. So we really focus on, my role is a lot more focused on let's get those widgets off the ground. So there's also a lot of capital that I'm meeting with. Mm-hmm. And there's a lot, from time to time, it's like, let's go in and study a widget and sit there and say, is there value add that we can kind of create here? But really, so it's, capital is a really big component of what we do. We can't run this business without capital. Capital is like oxygen, right? Mm-hmm. When it's flowing, you don't even think about it. You just breathe. And the second it stops flowing, in about 60 seconds.
You can't breathe.
And it's all you can think about.
Yeah.
So
where's your head? Is your head 1 year, 2 year, 10 years in front of us?
Probably not 10 years, just because I feel like we just, how many times have you thought about what's going to happen by December? Yeah. And you've been just so far off. Yeah. But we put a plan together in 2020 about we want to try and build the company to a certain production volume. And we were right up until mid-year 22, and the wheels fell off. Yeah. So I would like to get back to that level of production. And right now, that's mostly what I'm thinking about. So I think that we can basically get the organization to hit that $1.5 billion in multifamily production that we want. The goal for industrial is we want $500 million of production in a year. I do think that we can get the industrial up to $1 billion maybe by 27. We're going to need to add some bodies. We're going to need to add some deal flow and stack some opportunity in the machines so that we're kind of ready by then. But that would be a great goal, and that's kind of call it just under 5-year goal. And we're a production-driven machine, right? So we basically build really big widgets. So that's really the metric that matters the most. And then within that, there's tactical metrics about what gets capitalized today, what does not. And investors, today need a 7% return on cost, and yesterday they needed a 6%. And before the Fed started taking action, there was a 5 or 5.25 or something like that. So it's we're just trying to, tactically acclimate to whatever the framework is that we're operating in to allow capital flow. And then, when you're kind of sitting there saying, how do we want as an operator to take on risks? I mean, we're kind of managing that on an investment committee by investment committee basis. But there's some overarching themes that on what the risk profile wants to be at the point of guaranteed max price. We're going to push a project forward and start moving dirt around. If you think about investment committee, my brother and I co-chair investment committee. Talking back to Murray staying in his lane, one of the things that happened was the consultant said, "Hey, Murray, I think it'd be better if you don't go to investment committee moving forward." And my dad was like, "That's laughable."
Yeah.
And yet we got back to Texas, and he never showed up for another investment committee meeting, except for one. And the one he showed up to, he was just kind of curious. Like, "Hey, do you mind if I show up?" "No, come on in. This is a very interesting deal. Love to have your participation." So, so it's kind of interesting, how spread, a day can be. I mean,
your dad has modeled letting go and trust and training so well. But we talked about this in one of the podcasts, your brother, your dad, the collective I always go to golf. I love golf. Every professional golfer has one coach, two coaches, three coaches. They know they're the best in the world, and they need to be the best in the world. They get outside counsel.
Yeah.
The fact that y'all went and got outside counsel, you took the time, energy. You could say it's too expensive, it's too much time, all those things. Y'all went and got outside counsel. And I'm sure your dad negatively reacted the first time it was told to him. But by the time he got from Harvard back to Texas, he realized, I'll follow that advice.
Yeah. It was helpful. It was helpful.
Give us an overview on the current environment, right? And maybe not
in real estate.
Yeah, and not you don't necessarily have to speak to like what is Hanover going through necessarily, but just kind of like what's your, as you read the tea leaves, I mean, obviously multifamily's been in the headlines a lot in terms of distress and a distressed asset class. And so how do you guys view the world right now?
It's a dysfunctional capital markets, right? Because you got a 10-year that is jumping all over the place. And like, you know, even moving down 50 basis points like it did over the last 10 days, it's jarring.
Right.
And, you know, the move started really in, you know, with the base rate, SOFR rate moving up in 2022, kind of mid-year 22, started creating dislocation. We took big losses on dead deals in 2023. It's like, you know, I mean, losses, like, it's almost kind of one of those, like, you know, one of my jobs is to keep that loss line low.
Right.
And I blew it on 2023. 2024 is a lot better, and 2020, we basically took all our lumps in 2023. So it's like, this is going to be a better year. And the kind of losses that we might be looking at, I think if we kind of keep these deals alive and push them out, we're getting to a point where there's recovery in rents, there's costs coming down, yield expectations are kind of coming down as capital starts flowing again. So we might be in a healthier market on some of the remaining portfolio. But, you know, real estate in general, led by office, has some real dysfunction, right? And you have seismic shifts in the flow of people, the flow of work, where people are going to work and how they're going to work. And as bad as multifamily has been, and look, we've done what at a 2019, you know, idea was a great idea, and by the time we're sitting there in 2024, it's a terrible idea. You know, Oakland, California. It had a moment. It was looking good. Every developer went in. We went in not just once. We did 2 deals there because we thought it was going to be so great. And it's just been a disaster.
Yeah.
And, you know, we're not in there alone. But so I guess, you know, misery loves company. But like that's like the dumbest thing we did, you know, in the last 5 years.
Yeah.
And, you know, but, you know, and we, as we kind of like self-recriminate about that, I have other friends that are in office and like, no, I had 100% loss on my equity. And the bank took a 50% loss on their position. So it's like that piece of real estate is really dislocated.
Yeah.
And, you know, and I think there's recovery happening. The banks are healing. I don't say they're healed, but they're healing. I think some of the big losses that they were going to take, they have taken. And we've started having banks call us saying, hey, I got to deploy some capital this year. Maybe not historical norms, but we're moving money again.
Yeah.
Equity is mostly on the sidelines. They're trying to figure out where they can run plays, and big pension fund money is kind of like stuck, right? And redemption queues on big commingled funds are still out there. And you know, depending on which kind of portfolio manager you talk to, you'll get a different response about maybe the queue's come down, maybe the queue hadn't gotten any worse, but it hadn't totally gone away. So a lot of guys are net sellers while you still have that dynamic in place. And while you have and you're selling into a kind of a depressed market from a valuation standpoint, so a lot of guys don't want to sell. So deal volume is way off. And, you know, guys don't want to do development because you've got this concept out there that I can go buy below replacement costs, which in some cases is true. In other cases, our replacement costs are changing. And so there are some markets out there where it's like, I think the yields are at a place where I'd rather build than buy. Not every place in America. And like we still have rents that are, you know, you kind of have this 1.2 million units coming off the assembly line nationally. It's a big number. And we're going to have some pain in select markets, but it's like, even though the unemployment report was like, you know, 4.3%, huge surprise. It means more than 95% of the population is still employed. Like it's on any other like perspective, that would have been a phenomenal unemployment report.
Right.
And I think that really strong employment setup has really digested these apartments rolling off the assembly line over the last year and a half in a way that nobody in the industry expected. We have markets like, I'll take Denver, Rhino in Denver, which is like the poster child of oversupply. And we opened a deal there and like we're a nickel off trended pro forma rents. And, you know, in the history of like, you know, environments where we've had stuff kind of roll off the assembly line and what could have been sort of stressed environments, I'll take a minus a nickel every day of the week, twice on Sunday, way better than my expectations. And so, you know, so I think like the fundamentals in the industry are, if not healthy, And some markets, I think they're very healthy. I think they will be healthy by this time next year.
Yeah.
And this, real estate, it's an undulating ocean, right? Like the water level is never the same at any one point in time, unless you're in like a tsunami situation where the world's coming to an end and then it all crashes instantly everywhere all at once. The Hanover play is like, we're going to try and tactically play where we think the math wins. And we are math driven guys. We're just looking for inefficiencies in yield. And we're going to just try and play it tactically for the next year. We think that the environment is such that we can make plays. And when you get into really robust and healthy markets, you can make plays everywhere all at once. And we're not there yet, but we are seeing some really, really interesting plays.
Mm-hmm.
And we're in a reflation moment. So if you kind of think about yield on cost, unlevered return on cost into deals, going back 10 years ago to 2014, our average at the point of GMP, when we had real costs in, we were about to put a shovel in the ground, our average was about a 6.72% return on cost that year. So we got into like some of these really robust capital markets where it's like guys were buying stuff for 3 caps. We had to chase some yield down a little bit, and we were kind of like high fives. And if you look at the deals that we're putting into production this year, it's kind of drifting back up to about a 6.45-ish. And I think by the end of the year, when we kind of put the last deals that we think we're going to get in production, it probably drifts up a little bit over 6.5. So that's a recovering healthy market.
Right.
I don't want to miss it in our time. We're going to show it here at some point in the podcast. You got literally one of y'all's cranes, like 3 or 4 or 5
over our
blocks,
shoulder.
literally over our shoulder.
Yeah, it was great driving over here. I was like, construction's going pretty well.
So
Getting paint up.
we're in Dallas, by the way. If listeners don't know, obviously Hanover Company is based in Houston. What's going on in Dallas? What are you building? When's it going to open? What's going on here?
So we've got, it's a very interesting deal. So we put a site under contract in the depths of the pandemic. And so it was kind of, somebody else had under contract during the pandemic, capital evaporated, they dropped it. We picked it up for kind of like 75 cents in the dollar from their contract price. And we had a couple strategies. We ultimately said, let's go build a 2-tower site. We'll build one start, and then a year later, we'll start the next one. So GID, who's a massive partner of ours, they're basically running CalPERS Capital. They did the first one. And there's a single garage that goes between the 2 buildings. And KKR wanted to do the second one. But we had to buy the site at once. They had to commit to building the garage all at once. It was a very complicated deal, but in 2021, you could do complicated deals. And then I think we basically kind of got it all done. It was kind of like 2022, we kind of got it all framed up and actually closed it in 2022. We started the GID deal in like late 22, I believe. And we were ready to go in October of 23 with KKR. And KKR was like, hey guys, I'm still raising money. I've got this one development deal in my core portfolio, and I'm talking about buying below replacement costs. Having this development deal is just messing up my story. I'd prefer just to kind of not move forward with this. Can you get us out? And so we thought, okay, that's an interesting, it's a tough request right now.
Yep.
But we actually had a partner that we had done kind of a similar deal. They stepped in to another deal that we had with another partner, and they wanted to exit. And so we went to Mitsui and we said, Mitsui, here's the setup. Would you have an interest? And they were like, we love Dallas. Okay, well, this seems kind of complicated, but there's good yield here. We like the deal. And we basically kind of, after working through with KKR, and we kind of said, okay, here's the exit. Mitsui said, we'll step in. And we showed it to Mitsui in January of 24. And then we started production with Mitsui in April of 24.
Yeah.
Couldn't believe it. It's like, it's like financing deals twice. It's like the most inefficient thing we can do. We can't make a living of it, but it's like, we're happy to get it done in this day and age when
desperate times take desperate measures. And as God said, you got it funded.
Yeah. The location, y'all's office is in a phenomenal location. So we're just right down the road on Turtle Creek Boulevard. It's a great, great location.
How many units will that be finished out?
Finished out, in total, it'll be just under 700 for both buildings, and both buildings are kind of like one's 340, one's like 350 or so, 330.
So if I get into secret sauce here, just tell me to hush up. But as you all think about development today, these are all multifamily units. So is it What percent is it? 1 bedroom, 2 bedroom, 3 bedroom?
Well, just taking a step back, in general, for like the more urban stuff, it's more like 70-30, ones and twos.
Okay.
Sometimes you're kind of in some of these markets, and these buildings are a little bit more like that, where you might skew a little bit heavier on twos just because the single family values in this general vicinity are really high.
Yep.
And so some of the Texas markets have a little bit underdeveloped condo market. So that condo guy actually is also our customer. In California, Massachusetts, Virginia, we lose that guy to condos all the time, but we'll get him here.
Yep.
And so we'll probably kind of do more of a 60-40 mix here, and average unit size on the first one was like I want to say like 1050, and the next one's like 1150 or something. So it's a not too big, and we've got another deal up in like Northwest Highway, and that's kind of more like a 1,400 square foot average unit size, really catering to single family folks that are either downsizing, in transition because their house is being built, or kids that are wanting to kind of be around their
the one at Northwest Highway between Preston and Hillcrest?
Yeah, right across from the church there.
Yeah.
Yeah.
Okay.
No way.
That's a cool building.
Yeah, well, I was doing a construction walk at like noon today, so if I seem a little disheveled, I'm going to blame the construction walk.
Have you sold the penthouse yet?
We've not. So we're going to basically turn first units there in October. Northwestern Mutual is our partner in the deal, and so we actually had our friend over at Northwestern Mutual running through with us today.
So I live like 3 blocks north of there. And so I
I think they call these buy signals.
no, I've been trying.
These are
No.
called buy signals.
I've been trying to get my wife to downsize and go to a high rise, and she's like, never.
I was up on the roof today. It is lovely.
I bet the view
It's
is
a great
stunning
view.
up
These
there.
are buy signals. So this is where you're ahead with. This is called financing.
Right, yeah.
So you can get the penthouse paid for.
It's a good
Now,
deal.
Yeah.
Your
I can't tell you what it's
Northwestern-
priced at right now, but it's going to be great.
How big is the penthouse?
This is second buy signal, by the way.
So the top 3 floors, there's a floor transition, and I want to say the average unit size is like 2,300, but I need to check. But they're twos and threes
just
up top,
with all
which
the
is
glass and the big expansive view, up on top, it
and
looks cool.
it's a
Because he
rooftop
goes to
amenity,
church across the
rooftop
street.
pool.
He goes to church across the street. So when are we building the tunnel? When he talks about the tunnel, that's a very strong buy signal. Now your Northwestern Mutual, is that like Tate Cruz, or is this a whole nother finance part of Northwestern Mutual?
It's just like out of their Milwaukee
Their
office,
capital
and they got a
markets.
Dallas
'Cause
operation
obviously
down here.
The guy who owns or runs the DFW market is a good friend of mine. I think you know him as well. You're dealing with headquarters.
It's basically it's a real estate group, and it all sort of like flows up into Milwaukee, which
That
is
sounds interesting.
good folks over there.
Yeah,
Great folks.
Absolutely. Brandt, this is awesome. This is super enjoyable.
Well, I appreciate you guys having me on.
And I think I want to wrap it up here. When you get phone calls to sell your business, what do you and Jeb say? Well, how do you think about that phone call? Because I'm sure it happens frequent.
Jeb and I'm 46. My brother's 44. Running the business, like, we love it too much. We're just not interested, and it's just not it really is not a consideration. My dad at some point was kind of entertaining. He's like, I want to do charity work and all that. And we just said, look, we'll support you in the charity work. Don't stick us with an analyst at some company that we don't know. Like, let's just keep running this together. And I was like, look, Dad, like, it'd be great for you and I if, like, you're my partner for the rest of your life. It's like, you don't have to explain yourself ever. We're just going to invest together. We're going to run this thing together. You'll live longer. You'll live better. Let's just keep doing what we're doing. It's a fun lifestyle. So, like, we really enjoy it. We enjoy doing it. The business is fun. So that's really been the focus of, so it's like, it's just not that much of an interesting perspective, because you're like, what else are you gonna do with your time? Like right now we get to go build, think about what people need. People need food and shelter. We get to build the best shelter in America, all over America. It's an energizing existence.
I want you to drop that line. Either your business is running you, or
you're running the business. Yeah.
Because Brandt and Jeb have gotten to a spot where they're running the business is not running them.
That's right. I mean, you said it, but the business. Sometimes the business is running you.
Yeah,
and you get to a point of exhaustion where you're like, I can't do this anymore.
Yeah,
but it sounds like you guys have it flipped around where you're definitely running the business. It's energizing. It's giving you energy.
It is.
Versus taking away energy.
Right.
And as long as you can keep it in that spot, then you can go for a really long time.
Yeah. I mean, and we're pouring a lot of energy into the business.
Of course.
But it's a good energy. I mean, it's like you're getting what you're given here.
That's right.
Correct. Because so many of our listeners, that thorn has just gotten to where all they can see is exit and relief.
Right.
And they then end up in that position where they got 12 hours a day and they don't know what they're doing.
Right.
And that is where that tension becomes, is your business running you or are you running your business? Right. So kudos to you guys to figure it out. And obviously to your dad to continue to kind of hands off, let y'all lead. Brandt, super enjoyable.
Thank you.
Wish you the best success. And I can't wait to go visit Scott and Alicia's new home on Northwest Highway.
It'd be a treat.
Yeah. Well, when it's finished, I want a tour. I do want a tour.
And I want to go swimming in the rooftop pool.
Yeah.
Thank you for spending time with Decision Points.